let's talk about ratios and common size analysis. So when you want to compare different companies from the same industry, let's say you want to compare Apple and Samsung, right? Because you want to invest in one of them. Maybe you want to see the gross profit as a percentage of sales, which is basically a ratio called gross margin, right? And then you can compare that for the two companies, and it becomes very easy to know which is a better company in terms of profitability with respect to their gross margin, or maybe you want to see net income over sales, right? Which would be their profit margin or net income margin. So the point is that it helps us in doing comparison across companies. An example of common size analysis would be that instead of looking at that ratio, what we could say is sales and cost of goods sold and gross profit. So let's say the sales of Apple is $1 billion. Of course, it's a lot more than that, but just to keep it simple. And the sales of Samsung is, let's say, $1.5 billion. So clearly, Samsung has a larger sale, but if you will look at the profit, maybe Apple will be having a higher profit. Let's say cost of goods sold is 0.5 billion for Apple and 1.2 billion for Samsung, which means their profit is only 0.3 gross profit, that is. And for Apple, let's say it is 0.5 billion. Now, can we just compare the absolute numbers like this? Well, the answer is no. What you should do is you should look at the percentage. So that is where common size analysis comes in, where we're going to make the sales 100% and we will look at gross profit as a percentage of sales, which obviously is going to be 50%, right? And we look at the gross profit of Samsung sales, where we make Samsung sale 100% and 0.3 of 1.5 is 20%. So now this is something you can compare, that Apple has 50% gross margin, whereas your Samsung has a 20% gross margin, and that of course is a huge difference. I'm not saying these are real numbers, but I'm just trying to explain to you that how you use ratios and common size analysis to compare different companies, ideally from the same sector. Right, so common size analysis presents each line item on the income statement as a percentage of revenue. You can do this on the balance sheet as well, by the way. So common size analysis of the balance sheet, here of course we're talking about the income statement, but if you were doing it on the balance sheet, then it would be as a percentage of total assets. On the income statement, we do it as a percentage of revenue. This format standardizes the income statement and helps remove the effects of company size. So when you want to compare companies of different sizes and even across different time periods, that what is their trend, is their gross margin increasing or decreasing as a percentage of their sales, right? So it really helps with this type of analysis. And you can see that over here, that if you look at the gross profit percentage, it has actually come down for this particular company from 2017 to 2018. Which is clearly not good. So this is the use of common size analysis. The other thing is ratios. We already talked about the gross profit margin, which is gross profit divided by revenue, or the net profit margin, which is net profit divided by revenue, and of course operating profit, or which is earning before interest and tax divided by your revenue, also called operating profit. As an analyst, what are you looking for? Definitely higher margin ratios are more desirable, which means either the selling price is going up or the cost is going down, or both are happening. Well, that is it for this learning module. Let's have a look at the summary. So in terms of revenue recognition, we talked about these 5 steps. The first one being to identify the contract, breaking it up into different performance obligations, allocating or determining the transaction price of each performance obligation, and then seeing how each one is done and then recognizing the revenue for that. We looked at a lot of different case studies. Principal versus agent, where the agent only recognizes revenue for its fees or its commission. Franchising versus licensing, where you have to show the revenue from different businesses. Your own business, 100% revenue you can show. Franchised, only the royalty payments you can show, right? Software as a service is treated as a recurring sort of a revenue which is recognized once each rental period is complete. License can be at the same time, or again like a software as a service which is spread across different periods depending on whether it is a ongoing support service or is it a one-time thing. Long-term contracts are also like software as a service or an ongoing arrangement where you keep billing as the contract period is going on. And bill and hold arrangements, you can bill all together even though the delivery might not be done, because you're holding the delivery at the request of the customer, right? And of course, this is all a principle based accounting standard both in US GAAP and IFRS, so a lot of judgment possibility is there, and that is why the analyst should go into the notes of the financial statements to get a deeper understanding. In terms of expense recognition, we talked about the difference in product costs and periodic costs, and how product costs are only going to show the ones which are sold in that period. Otherwise, they will remain in the inventory and possibly sold in the next period. Whereas some of the expenses can be capitalized into long-term assets, right? And then naturally they are expensed out as depreciation. So companies have certain estimates that they take in terms of the useful life and the depreciation methods. So they could either be doing early recognition of expenses or they could be delaying the recognition of expenses. We as analysts would prefer delaying over early, because we would prefer early recognition because that is a conservative approach, and delaying of the recognition of expenses, for example having a longer useful life, which would mean that you are delaying the recognition of expenses, is going to be an aggressive approach. So we don't want the useful life to be longer than what actually is expected to be. Then we talked about income from discontinued operations has to be shown separately net of tax, and you can allow the accounting standards you do allow you to recognize gains and losses from your unusual or infrequent items. However, you have to show them separately, and as analyst you have to pick up these unusual and infrequent items and just check them whether they are really that infrequent. Or remember the Indian textile exporter example I gave you, that it is possible that some of these gains or some of these losses could be a recurring item. In terms of changes, we talked about the changes of principal versus the changes in estimates, right? And here I'll say policy. So this has to be done retrospectively, whereas estimates can be done prospectively. And if you have any error, then that just has to be fixed by updating the opening balance for your retained earning. And there is a modified retrospective approach which has a similar situation where you can just adjust the opening balance of your retained earning. And of course, to the meat of this entire learning module, the calculation of basic EPS and diluted EPS has been discussed in detail in the respective sections of their videos. And finally, we talked about your ratio analysis and your common size analysis, very useful for comparison across different companies and different time periods, but ideally these companies should be in the same industry, right? Otherwise the ratios don't make sense to compare across different industries. It should be ideally within industry peers. So thank you very much for watching the videos for this learning module. I hope you enjoyed them. Please go through the end of reading questions in your curriculum for this reading. It's a very important reading from your exam perspective.
$250, $220.